I'm Georgia Alfredas.
And I'm Dave Mathews, and this is the show where we talk about what's next on Wall Street, because we're Germans.
This is the show about winning trades.
Well, we want to help you learn about trading in a fun, entertaining, and most importantly, a useful way on the Autobahn.
Yes. Now we're going to talk about all the hot new trending products and services that you'll not only want to buy, but you'll want to use and invest in. I see the Autobahn. I get it. Okay.
Yeah, we're also going to cover the fundamentals of those companies to make you an informed trader and make it easier to target investment potential. Plus, we'll share our thoughts on where the charts and indicators say a particular stock is going.
So all of this information can help you create a tailored trade plan and stay up to speed on what's next on Wall Street, so that all you have to do is stack your gains. No.
Yeah.
No, just one person needs to say it. Stack your gains.
You can email us. You can email us at OptionsPlayers.com or hit us up on social media at What's Next Wall Street with your questions.
Yeah.
We can also direct you to instructors and experts over at Options Players who dig into those trading fundamentals.
Yes, sirs.
Let's go to the stock minute.
Yeah, let's get it. I don't know if it's the stock minute. Maybe I should say NFT minute. Y'all, are we still doing collectibles? I thought it was so last month. All right, but rapper and entrepreneur GenZ is making moves in the collectibles world. GenZ, Rock Nation Fanatics founder Michael Rubin, Miami Heat forward Andre Iguodala, I know I said it wrong, Iguodala, okay, and current Philadelphia 76ers president of basketball operations Daryl Morey are investing in the Certified Collectibles Group to acquire a majority stake in that company. So, according to Business Insider, the company revealed their evaluation following the completion of the transaction would be no more than $500 million, or actually would be more than $500 million. So Jay-Z's recent dealings in tech and collectibles have only increased his net worth. Okay, so listen up. Earlier this year, he sold out of Ace of Spades champagne to LVMH for $300 million. In May, Jay sold title to Jack Dorsey for another $300 million. And his cannabis company recently joined forces with a few other cannabis companies in partnerships reportedly worth over $500 million. So basically in the spring, he made like $2 billion. I mean, he's like,
well,
man.
Georgia, Jay-Z may be cash rich, but he was also on an NFT buying spree and proved it by changing his Twitter profile picture to a cyberpunk AVI and Avi, sorry.
So
like
yeah,
an Avi, you know
like
what I'm saying?
Yeah, like that CryptoPunk Avi. Yeah.
Yep. And did you realize he follows no one?
Not even us?
No, not even you or the other queen bee, his wifey. Isn't that a weird floss?
Yeah, so weird.
Well, Jay-Z bought his cyberpunk avatar back in April for 55 Ether, which was worth $126,000 at the time. However, because of the volatility in crypto, it's dropped in value to just $102,000. But you know what? I bet he doesn't care.
He doesn't care, okay? In addition to that, Jay-Z partnered with Sotheby's Auction House for an NFT based on his debut album, Reasonable Doubt. Now, Jay-Z hired a digital artist to create this one-of-a-kind animated digital collectible. Now, it's meant to recontextualize the album cover, which kind of did. So it was initially released over 2 decades ago, like 25 years ago. It sold for $138,000. You know what, though? How about this? I started looking at stuff up for auction at Sotheby's. How about Slick Rick's diamond eye patch? Sold for $25,000. Andy Warhol's set of Campbell's Soup 2 sold for almost $6 million. A photograph of toilet paper. I'm talking about a photograph of toilet paper. Sold for $52,000. However,
was that during the pandemic? Because that stuff was sky high then.
Probably. So a letter written by John Quincy Adams about the Quasi-War sold for $18,000. So you mean to tell me you want a photograph of toilet paper for $50,000 and a letter from Quan? It doesn't make sense. Anyway, I don't know what that shows you about society and what we care about. I guess toilet paper. Meanwhile, a portion of the proceeds from the auction will go to Jay-Z's Sean Carter Foundation. So that's a good thing.
All right. Today's What's Next Wall Street pro tip is brought to you by OptionsPlayers.com. Today we're going to talk about stacking gains versus holding and praying, which is what I used to do. Options Players knows a lot about stacking gains. In fact, they trademarked the phrase, stack your gains. Why? Because they love you and because it's what the traders and instructors in the community preach. The market moves and gyrates constantly due to many factors, especially news and rumors. So while you can be in a bull run market, you can still experience volatility.
Yep.
Entering a trade plan with a tangible goal of stacking is much easier than managing a position without a definitive exit or stops. Many diamond handlers, which you can watch last week's episode to learn Georgia talking about that, they're learning this lesson the hard way as they accumulate losses or miss cheaper entries into their favorite tickers. Now, those that stack are able to accumulate even larger positions with no additional principal necessary, and that, my friends, is financially attractive. So why don't you devise a plan to stack gains and compare your results? And let us know in the comments.
Okay, this is the part of the show where we get to hear from you. You can always hit us up on social media at What's Next Wall Street or email us at WNW@OptionsPlayers.com. Our first email comes to us from John in Waco, Texas. John wants to know, John asks, I always hear about catching a falling knife. What does that even mean, and should I avoid it? You tell me, John, should you avoid catching a falling knife? I'm just kidding. That's a really great question. So many stocks take the escalator up only to later take the elevator down. A stock drop is usually more swift than the rise. So it's really important to stay clear of these elevator drop situations and to patiently wait for things to settle and play a reversal. So to try to get in before a confirmed reversal is what we call trying to catch a falling knife. And it can be as painful as it sounds.
My broker and I were talking about this today, and that means you can put a stop loss in. So if you buy at $30 or $40, you can sell at 20 or 18 before it hits 10.
Yeah.
So our second email comes to us from Alec in Buenos Aires. Alec asks, where are some good dividend stocks and what makes some of them better than others? Another great question, and I'm going to toss it over to Greg Krause, lead instructor at OptionsPlayers.com, because he loves these dividend plays.
Yes, he does.
Don't you, Greg?
Hey, Greg.
Hey, Dave. Hey, Georgia. Of course I like dividend if you're going to give me free money, but there are a few things where people are misled about dividend stocks. So the biggest misconception of dividend stocks is the higher the yield, which is going to be the larger dividend you're going to be paid. They think it's always a good thing. There are some stocks out there that may pay well into the double digits, but many people just simply choose that the highest dividend is the best paying stock. And this is not always a great idea. There are some things you need to look for. So one of the main things you need to look at is what they consider, it's called the payout ratio. Now, I don't want you to get too crazy about the math, but it's basically the amount of money it pays per share divided by the earnings per share. And it kind of tells you the percentage of earnings that it's paying to the shareholders, right? So that may sound like a good thing if you're shareholders, but that's all the profit they made. So how are they reinvesting that into the company? Where's their growth coming from if they're just paying it all out in dividends? So normally I would say, if I'm going to give you a textbook answer, it would be like 60% or less. I'm a little bit lower than that. I'm normally looking about 40% or less to be that dividend is sustainable. But there are other things. It's a very good sign if the company raises its dividend year after year after year. A good example of this is AT&T. I think I'm not even going to tell you how many years it is, but it's been like 35 years, and they've offered a dividend for over 100.
Greg, you just told us how many years.
Yeah.
I know. What I mean is I could be slightly off on that one, all right? But dividend purchasing, or dividend, I'm sorry, with AT&T purchasing Discovery, that's going to dilute their dividend now. So that dividend that used to be about 6%, that yield's probably going to be about 3 to 4. We're unsure what that's going to look like until that merger actually goes through. The big thing about it is for any company, and this isn't just for dividend stocks, is what is its competitive advantage? All right. Does it have proprietary technology, high barriers to entry, which could switching cost. I know this is more business related, but that's what you're really looking for. Or just a powerful brand name, such as Apple, right? It has, of course, technology, powerful brand name. And to get into that, there's going to be some barriers to entry because it's not a monopoly because Apple isn't even one of the top 2 largest selling ones, but it is what it is. You're not getting into the phone business anytime soon. Everybody's tried, and they just get smashed by Apple and Samsung and everyone else.
Hey, Greg, with AT&T wanting to buy Discovery, and they've got a fire sale for DirecTV, is that a little, pushing the rope? What is that?
Well, the DirecTV thing, however, everybody's been trying to buy content. That's nothing new. Everyone's trying to get content, and going after DirecTV was maybe AT&T's way of getting into that services field for maybe their future. You see this happen a lot in companies, and I'm not on the AT&T board, so I don't know what their actual strategy was there, but they did lose some money on that. So I don't think their strategy was to lose as much money as they did. But a lot of companies will stick their toes into industries and lose a lot of money just so they get the experience and the know-how to actually start their own or to actually find one that's better. Now, as you said, the DirecTV one was a huge purchase. So I don't think that was their play. I think kind of like maybe how Netflix is getting into gaming a little bit, how that is putting their toes into gaming. They're not trying to make money, but they're not spending too much just so they get the experience. You see Apple with this also with, say, the Apple Car. They're spending money on that research, but they're not really planning on producing it just in case it comes down later on. Mm-hmm. This was a big one with Apple for over a decade with producing its own chips. And of course, now they do.
Yeah, I thought the AT&T buying DirecTV was a way for them to really put a strangle on those license negotiations for all those different channels. And I was an early subscriber to AT&T. It was called DirecTV Now, which became AT&T Now. It was $35 a month for a ton of channels. Same. And then over the course of 4 or 5 years, they raised it up to $79 a month again.
It's crazy.
So I literally canceled it this week. I'm like, how do you say you're never going to raise prices at $35 and now it's $80? I don't watch TV enough to justify that. But they were supposed to go over the internet and not have the legacy costs of satellite.
Yeah.
Yeah, I don't even want to say what my satellite bill is with DirecTV, and I have AT&T. It's way higher than $70. Put a 1 in front of that, maybe. Yeah, and I mean, I don't even watch it either, but who cares? $107 for me. But it's something, that's an example of a great dividend that was about 6%. That AT&T was the who's who of dividends in the S&P 500. It was it. That's what everybody wanted to invest in. And besides those other, the competitive advantages, its payout ratio, has it been raising its dividend? Also just sometimes you just get a price or a yield that might be too good because a price or a stock dropped. Take Ford, for example. When Ford dropped pretty low last year, I was able to acquire some Ford and with a little cash secure put and then actually get it assigned. And my ratio is almost double digits on that. So, and Ford's going to pay that dividend now, and then they stopped paying the dividend. So now I'm just waiting for them to come back so Ford can pay that dividend to me. So I kind of got messed up on that, and I'm a professional stock trader. So that's, everybody makes mistakes on those. So don't just go after dividends, because you have to understand if they're paying you a dividend, they're not putting it back into the company. Now, there are a few great companies that offer dividends and, are very positive companies. Apple, Microsoft, Verizon is kind of like AT&T. It has a little bit higher one. And you see a lot of real estate investment trusts. A lot of people enter those because they normally have higher dividends.
And when you see the stocks trickling into your account like 0.1%, those are the dividend payments. They don't actually write you a check, right?
Yeah, yes and no. Okay, it depends. So you need to talk to your broker, and then some will pay it out cash. But one thing you need to talk to your tax advisor about, or your financial advisor, is the tax implications of dividends. If I purchase, say, a stock with no dividends, or just say Apple, it doesn't have a crazy high one, and I hold the stock for over a year, I'm not going to pay capital gains tax on it. While almost all dividends in the United States, at least, are considered capital gains tax. Okay, so you're not going to get that extremely low tax rate on it. Now, there are some out there that it goes into repurchasing shares and things like that are an advantage. And this is kind of where Apple comes in. And for example, Apple does buybacks, right? So what does a buyback do? Apple's spending its profits. Instead of handing that money directly to the investor as a dividend payment, they purchase stocks, which in theory reduces the supply, so even with equal demand, raises the price of the stock. So that's another way that Apple does it, is through their buybacks, which of course limits your tax liability because you're not getting that dividend payment, but the stock went up. So whenever you want to sell it, it should have went up. So
well, let's hope they do that, because Apple had a quarter of record earnings last week.
Yeah.
And I'm a shareholder in Apple, and I could use that buyback. Hey, Greg, thank you so much for that information. Stick around. We might need you a little bit later in the show. Hey, Georgia, what's the most annoying thing about your most amazing iPhone?
My battery, of course.
Yep.
I guess
That's right. They keep making the phones thinner and cramming more batteries in and make the processors run cooler and more efficiently. But the more you use it and the more you depend on it, you more want that charge indicator to never below that 20%.
Oh my gosh. And it's always below that 20%.
Yeah, do you know when you deplete your battery to exhaustion, like all the way down past the 10%, it's not really good for those cells. So keeping it charged at the 20% mark is best for the long-term health of your phone.
Ooh, didn't know that.
But that's only if you're keeping your phone for more than 2 or 3 years.
Okay.
But how you charge the battery quickly without being on a cord like a old handheld.
Right, exactly. That's me every day. That's me every day. So I just got the new iPhone 12 and it didn't even come with a charger. I was like, what? I had the box like, what?
That's right. For years, Apple bought or gave you didn't have to buy it, this little bitty cube. And the cube charges at 5 volts and 1 amp. So that means it's about twice as fast as plugging your phone into your laptop to charge.
Okay.
And then the iPads came with a little bit larger brick, and we can go to the desk here and show that.
Okay.
And that larger brick would charge at like 12 amps. But now you can buy aftermarket chargers like this that have 2 different charge ports. And I have a little gadget here. You know I like gadgets.
Yes.
And this is showing my iPhone connected to the Apple charging cable, connected to the Apple charger that I just showed you a minute ago. Now this one's the one that comes with the phone. And it's charging at 5 volts and 1 amp. Now watch this. If I pull this out of the Apple charger and I'm going to move it over to my little Anchor charger, and it has to boot up. And now look what's happening here. It's still at 5 volts, but it's at 1.7 amps. Now this will charge based upon demand from the phone at up to 2 amps, 2.4 amps in some cases. So you're putting double the power into the phone to fast charge it. Now watch this, it even gets cooler.
Okay.
I'm going to unplug this from this USB port.
Okay.
And I'm going to plug in one of these little wireless chargers.
Right.
So the wireless charger, these are the little pucks. And let me boot it up here by plugging it into my gadget. I'm going to line this here as so. So if you use these little wireless pucks.
That's what I always use.
Yep. I'm going to put my phone on this.
Okay.
And watch what happens. Now these pucks, you think this is brand new technology, right?
Yeah.
It's charging at 8 volts instead of 5 volts.
Okay.
But look, only a half an amp.
So is it charging slower?
It's charging about the same as the little bitty cube. So if you want to charge the fastest, use a big cube. Or you can use what's called USB-C. And that's this connector here. Now watch this.
Okay.
I'm going to unplug the old charger. I'm going to plug in the gadget into USB-C.
Okay.
Plug this into my phone. We might need like some piano music during this little dance we're doing here. Okay. So now I've got my gadget plugged into a high power charger and that plugged into the phone.
Got it.
And it's going to take a second to synchronize here. So look at this.
Oh, wow.
It's doing 5 volts and it's going to ramp up 8 volts.
Oh, no, gosh.
And now it's 2
It's going
amps,
up to 2. Yeah.
right?
Yeah.
So we're pushing more and more energy into this, but you might not want to carry a big brick like this around.
Yeah, who's going to take that around?
Exactly. So there's this little guy. This is brand new. I actually see these guys from Anchor showing this on the ads on Instagram.
Okay.
So I'm going to unplug the big brick. I'm going to plug in this little one.
I would hate to travel with you.
No, I've got a charger for every situation.
I'd be like, what, dude?
So now it's putting out 5 volts. It'll ramp up to 8 volts. So it's putting almost the same power from that little charger as Apple puts out from their larger
big one.
charger.
Okay,
right?
Got it.
So, and look at the size of this. This is almost the same size as the little brick that Apple shipped with the original iPhone. So this is an Anchor charger. It's called IQ, and the key for these things is you have to use USB-C, which is the oval connector that most modern laptops use these days. But USB-C is the only way you're going to get this high current into the phones. If you use the old USB-A, they call it, this will not push the high voltage in. So grab an Anchor adapter and a USB-C and don't use the wireless charging unless you want to charge overnight.
Okay, so that's how I usually use it. I put it on there overnight, but what are we talking here? If I'm using the smaller one or the large one, like it's going to take 10 minutes longer or an hour longer.
So if you use USB-C with the larger charger, you can charge more than 50% in 30 minutes. Sometimes you can get 70%. And these current phones, like the iPhone 12, have a massive battery inside of it.
Okay.
And if you have one of those power bricks, you might carry a battery with you. Those batteries are even larger. So for those, I wouldn't even try charging them without a laptop style or an iPad style charger, because if you're using one of these little cubes to charge them, it's going to take 2 days to charge with it. It's that drastically different. And if you buy chargers at Walgreens or at Kohl's, those are not the best designed chargers.
What?
Try and stick with the real Apple products or a company like Anchor, because they're making stuff that's not only fast, but it'll also last. I mean, look, buy one at Walgreens if you're in a bind, but it's your phone, man. You've spent $1,000 or more on that phone. You want to put the right voltage into it.
So you're saying I can't buy my charger where I buy my gas?
Probably a bad idea unless you're in a pinch.
Okay. All right. Thank you, Doug. Okay, so I want to talk about where we spend our consumer dollars. Obviously, the gas station on chargers. But I want to talk about what matters most to consumers and how that translates to investors. So we've talked before about millennials and Gen Z who want to shop socially conscious and sustainable brands, right? Sorry, Gen Xers, we are not the driving force of the economy anymore.
I am with chargers.
I know, right? So can you believe I have a millennial, a Gen Zer, and a Gen Aer? Yes, there's some Gen A or a Gen A is a thing.
That's like my old refrigerator my parents had.
No. Gen A is the kids born after 2012, but I digress. Okay, so there are tons of companies that will help workers pay for college. Walmart they're going to pay full college tuition and books that just came out. And not only for full-time employees, but part-time employees as well. Dawn's dish soap helped save the ducks. Domino's helped fill in potholes. Patagonia helps with the environment. Bombas donates socks. Tom's donates shoes, et cetera, et cetera, et cetera. So companies are increasingly incorporating CSR programs.
Wait, what's CSR? A customer service representative? I hate talking to those people.
No, not exactly. No, it's corporate social responsibility, basically sustainable capitalism. But what does that look like for investors? So let's just go with something that I consume way too much of, Ben & Jerry's. Dave, quick. What's your favorite flavor of Ben & Jerry's?
The Tonight Dough, Jimmy Fallon's, of course.
Yes. All right. Okay, that's cool. So Ben & Jerry's is an incredibly socially conscious company. Talk about guilt-free ice cream. There's no such thing. But anyway, Ben & Jerry's has been on the forefront since its beginning with advocacy in issues like climate change, fair trade, racial justice, LGBTQ equality. I could just go on and on. Recently, though, Ben & Jerry's announced that they're going to no longer sell their products in what's called the occupied Palestinian territory. Now, their new Prime Minister, the Prime Minister Bennett, went so far to call that anti-Semitic and said, you know what? He asked U.S. states with laws against Israel boycotts to sanction Ben & Jerry's. So Texas was the first to jump on that. Texas said they could ban their government-backed retirement investment into Ben & Jerry's. Now, of course, the company is promising to stay in Israel, but under a different arrangement. Ben & Jerry's parent company says it is fully committed to Israel. So the question is, does taking a hard stance that may be socially conscious or political hurt a company's bottom line? I don't know. Let's ask Greg Krause, lead instructor of OptionsPlayers.com. Hey, Greg, what say you?
Every company, as you said, any large company has a plan in some way to have a corporate social responsibility. You know, they probably have a whole team that's on that, to either do environmental, ethical, economic responsibility, something like that. And often it's part of what sets them apart from their competitors. Now, Ben & Jerry's, although they are the leading brand, I believe, in ice cream, private labels actually make more, but individual, they make the most, or they sell the most. But is it a good thing? Absolutely. It separates you, like I said, it differentiates from everyone else. I think a good example of this would be not going so political like this, because I'm going to stay away from this one, okay? I'm not going to touch that.
Right.
But think about Tom's shoes, right? You buy a shoe, you give away a shoe.
Yeah.
Now, if Tom never gave away that second shoe, who would ever have bought those shoes? Absolutely nobody.
Okay.
No, you would have never known about them, right? Because it would have never made the news. It would have never been a trend. It would have never been popular. So that's kind of the thing. Now, when I think about Ben & Jerry's, I don't really think, man, this is a social responsible company. I don't think that. And I mean, I teach business, so I actually teach CSR things. So I know they are, but it's just not what it comes in my mind. When it comes to me is, I don't really eat Ben & Jerry's because it comes in pint signs, and I want like a gallon of like Bourbet.
That's why they sell more. Come on, this is like putting a larger hole in the Tabasco bottle so you sell more Tabasco. Same principle, but different.
Yeah, I see it, and it's just too small. But many companies, they do take, it's a trend. So if this wasn't news, would they have done anything? I don't think they would. And I'm not saying it's bad form or they don't really believe in what they're doing. It's taking advantage of trends and news coverage to get publicity. And the old saying, right? No such thing as
bad publicity. And we are talking about them. But I'm talking about them because I really am going to eat some when I get home. But I'm just saying, go on.
Yeah. So if it's good publicity, so well. If it's bad, it is what it is. It's in the news. It's noticeable. There's, so there you go. But now you brought up Texas and limiting their, I believe it was their
retirement investment. Yes.
It's even worse than that. Okay. And this is where you get into, I would have to think a company the size of Ben & Jerry's would have known this. But Texas has a law, Chapter 808. Okay. I only know that because I lived in Hawaii for a while. All right. That bars companies from refusing, terminating any business, or doing any action to penalize or inflict economic harm or limit relations with Israel. That is right.
I love that you
Texas
just whipped that 808
Wow.
out of that's good. Yeah.
So Texas has a law to stop people from basically causing economic harm to Israel. Now, I would also like to say, is that legal to have that law? Because Texas is a state, so they shouldn't be involved with foreign trade.
That's a great point.
But I'm not a lawyer, so I don't know where that's going to go, but I do know that's a law.
But wait, what about other countries? Do we have that law for other countries or just Israel?
I'm pretty sure there's some other ones. I know that one's there.
Yeah.
from personal dealings. Just like, I
tell.
wasn't trying
No,
to
just
get
kidding.
with Israel or something, but we were trying to sell there. And then my lawyer was like, hey, here. And I was like, what? Are we serious? It's like, this is a real thing.
Wow.
And I was like, well, I'm not going to do any economic harm. And this comes back to, why does Ben & Jerry not want to sell ice cream in the OPTs? Like, don't you want to give them free ice cream? If you know you want to be socially responsible to the Palestinians there, now the Palestinians just don't get your Ben & Jerry's. I mean, what good is that?
I see what you're saying, but maybe Ben & Jerry's like, look, we're so big, we don't care, we don't need it. I mean, is that maybe their thinking?
I've been there though. It's really hot. It might be a supply chain issue. It might be too hot. They can't get cold trucks there.
They were going to continue to sell it in what they consider to be Israel's territory, but not sell it in the occupied territories, right?
Yeah.
Or what they considered occupied territories. So basically, you're still going to sell it to the people who are occupying the other ones, if that is your belief. So why? Like,
maybe they didn't think that through, is what you're saying.
Yeah, I'm just saying it kind of, to me, seems that it was a publicity stunt, maybe. And I don't want to say that because but why not limit all of Israel? Why are you going to just take it out of the areas that are already being, if you believe
they're
whatever,
they're already being occupied. I know,
oppressed or whatever. So now you just took away Ben & Jerry's, man. That could have been the one thing they liked.
Well, we'd like to thank lead ice cream eater and instructor Greg Krause at Options Players for that information.
Yes, thank you for being here. Okay, remember, if you want to know something, we probably have the answer. And if we don't, Greg's going to have the answer and he's going to tell it exactly how he feels. Please know that. You can hit us up on social media at What's Next Wall Street. We want to hear from you.
You've got questions, we might have answers. Hit us up, follow us, like us, smash the bell, ring the ding.
www.optionsplayers.com. I'm Georgia Alfredas.
And I'm Dave Mathews, and I'm going to get a pint of Ben & Jerry's.
Okay, my favorite is Chunky Monkey. I can call myself a monkey, you cannot. Don't even do it. Don't even think about it. We don't play those games.
Thanks for watching. Chunky Monkey.
Don't.